There are a few interesting things going on. I'll put this down to the open of the week. It's the open of the day and the open of the week. Later in the week, it'll be important. Today, we'll pay attention to it as open of the day. I think the market's going to rally. And the reason I say that, I have several reasons to say that. Friday was fairly climactic, so there's a 75% chance we'll have at least a couple hours of sideways to up trading today. That starts by the end of the second hour, number one. Daily chart, we have arguably a wedge, 1, 2, 3. Now we have possibly a micro double bottom, but this sell-off looks more like a bear leg in a trading range or pullback in a bull trend than it does a bear trend. This is what a bear trend looks like, lots of big bear bars. Here we have bear bars, bad follow-through, bear bar, bad follow-through. We had two bear bars here, but then bad follow-through. This sell-off looks weaker than this rally. It's a 50% retracement of the rally. It's a test of the breakout point, and we're not collapsing below. Weekly chart. We have two consecutive bear bars. Why does that matter? Because of this. We're sideways for 9 months. And when the market is sideways when the market's in a trading range, it typically has a hard time going in one direction very long. This rally was still part of the bull trend. It turned out it was part of the trading range that began somewhere in here. But it's still part of the bull trend. That's why the bulls were able to get that many bars. But other than that continuation of this bull trend, the reversals are coming every 2 or 3 weeks. Well, we've been down for 2 weeks, so we're probably not going to be down this week. Monthly chart, well, it could go either way. You can see we're in the middle of a 9-month trading range. We have a big bear bar, but all the other bars have tails. And we're now in the second half of the month, so the month is probably not going to close on its low, which means it's going to close above its low. We don't know that we've seen the low of the month. We may have, but it's probably not going to be a big bear bar closing on its low. Can you buy above 1? Sometimes you can. One obvious problem is it's 20 points tall. So if you do buy above 1, you have to trade small. We just went above the Globex high, small Globex range, so possible that we break both the top and below the bottom. That happens about 10% of the time. A couple days a month, you break out of the Globex high and the Globex low. So the odds are we're not going to go below the Globex low. Here's the low of the day currently. Now, a lot of traders don't like to risk too much. So some traders, instead of buying above 1, will hold and wait for a pullback. Also, for me, to think of it as a buy the close rally, I'd like to see follow through. So I'd like to see 2 bull bars with at least one being big and closing near its high. So far, 1 is big and it has not yet closed. If it closes near its high, that would be good. But I'd like confirmation. So I'd like a second consecutive bull bar. But as I said, because of the daily and weekly charts, I think there's an increased chance that the market is going to try to go up, possibly into the end of the month. What do you do here? Well, if you buy above 1, you have to trade very small. And it's fine to do. And what's very small? I usually think of trading as having 2 position sizes. One is your normal size, and then one a small size. And the small size, I think it's better to make it like 20% of the normal size. So if you normally trade 1 E-mini, that's the same as 10 micro E-minis. then 2 micro E-minis, and put the stop down here. And if it keeps going up, you buy 2 more, 2 more, 2 more, and you can build up to a normal size position. And if your stop gets hit, even though the stop is far below, you're not going to lose all that much money. Better to make it like 20% of the normal size. So if you normally trade 1 E-mini, that's the same as 10 micro E-minis, then 2 micro E-minis, and put the stop down here. And if it keeps going up, you buy 2 more, 2 more, 2 more, and you can build up to a normal size position. And if your stop gets hit, even though the stop is far below, you're not going to lose all that much money. There's a problem with the Alice Notes program, and the administrators are trying to fix it. So it might take a little while before the typing, before I can type. Can this simply be like this rally, a lower high in a bear channel? It can be, but most traders are not going to sell below 2. They would want 2 or 3 bear bars on a micro double top. The bulls, at a minimum, want no bear body. Even if it's perfect doji, that would attract buyers and increase the chances will go higher. If it's a bull bar, the bulls would like as big a bull bar as they can get. They would like the bar to close on its high. They would like the bar to close above the high of bar 1. They would like the bar to close above the moving average. They would like the bar to close above that March 3rd breakout point. The past 5 days have been a test of this breakout point. We broke strongly above it. We're pulling back and testing it. The bears are trying to break back below it. The bulls are trying to prevent it from breaking back below it. So the bulls are trying to get a micro double bottom, down, up, down, and they're hoping we go up from here. Now, what about the bulls who bought the market or bought during one or bought the close of one? Their stop is still below 1. If we get a couple big bear bars before the stop gets hit, they might get out before waiting for their stop to be hit. But right now, this is a good candidate for the low of the day. Bar 1 always has at least a 20% chance of being either the high or low of the day. Depending on context, the probability could be as much as 30%. And right now, there's probably a 30% chance 1 will remain the low of the day. Now we have a second consecutive bull bar, so it's probably 35 or 40% chance we've seen the low of the day. Probably more buyers than sellers below 2. There's one other unusual thing here. I don't know if you see it. The open of 1 is exactly at the low of the day. And why is that interesting? Well, here's a daily chart. And how many days is the open exactly at the low or exactly at the high? You can say, well, isn't this one, isn't that one? About once or twice a year will the low of the day be the open of the day, or the high of the day will be the open of the day. This is actually a tail below there, so it looks like it opened on the low, but it did not. And if you check all the other days that look like they opened on the low or opened on the high, they all have tails. Let me check this one. 375. Nope, this one also has a tail, and that's the one thing that works against this. Is for the bullish case, it's the one thing that increases the chances we'll go below this. I am long. I bought below 2. I'll scalp out part. 4400 has been a resistance level. Bar 3 is the first 15-minute close, and the bulls are hoping that bar 3 closes on its high. A fairly tight bear channel, it increases the chances that we'll have to stop going down, start to go sideways before we can go up, like this. Here, sideways for a few bars, and then we went up. I just exited part at 4,400. I don't want it to come back down. So I'll get out if it gets down near that too low again. Tail on the top of 1, tail on the top of 2. So you will get some bear scalpers selling the 2 high, trying to make 5 points, 10 points. 3 consecutive bull bars, I just got up. 3 consecutive bull bars, but all have prominent tails. This is still a good candidate for the low of the day, but I'm concerned that we're getting hesitation around resistance. That March 3rd high, 4,400, and the moving average. So right now I'm looking to buy again, but I'm probably going to wait for a pullback. If we start to break strongly above all the resistance, I might buy the close of a bar. But right now, I suspect we may pull back a little bit. For the bears, it's a second reversal down at resistance, but it's 3 bull bars and one of them exceptionally big. So you'll get bulls exiting below a bear bar 4, if it's a bear bar, but you'll get fewer bears willing to take the short because they think the reversal is minor. When you get these big moves, a lot of traders don't want to risk all the way down there, so they want to buy a pullback. And they'll often place a limit order to buy exactly at a 50% pullback. And that's why a lot of the pullbacks go 1 tick more than 50%, because there are a lot of traders trying to buy with a limit order at 50%. Other traders wait for the 50% pullback, and then they wait for a bull bar reversing up from 50%, and then they buy. Currently, this is 50%. Yesterday's close, yesterday's low are also magnets. Can this be a bull trap like this? It can be, but it's probably not. Right now, I would say 50% chance we've seen the low of the day. We could go sideways all day, but right now, 50% chance we're not going below that. Why only 50%? Because it's still early in the day. So strong moves on the open, in general, 50% chance they are traps. They're the wrong way. And then I talked about the open being exactly at the low. I don't know that that's true. I'm going to check the CME website. I'll do that now. The CME owns the E-mini, so they get to decide what the prices are. So if you want to find out the exact price, you can look at the CME website. And just because there's no tail on TradeStation does not mean no tail on the CME. And I'm going to look at the CME website right now. And guess what? There's a tail on the bottom of the bar on the CME website. So this price is wrong. Even though TradeStation says they get their data from the CME and their data is 100% right, well, it's not right. I'm going to turn off the screen for a moment and see if I can pull up the CME chart. You can just do a Google search for E-mini price chart CME. and you'll see this. And then here's the June contract, here's the chart. It's delayed data, so it's like 10 minutes delayed, but we're more than 10 minutes into the day, and it's also a Globex. So this is the first, that's 1 minute chart, I want a 5 minute chart. Okay, so here's the first 5 minutes of the day session, and you can see there's the open right there, and the low is below the open. Remember, this is a delayed chart, so the TradeStation chart has more bars, but this bar on TradeStation is this bar on the E-mini, and you can see the open is there and the low is there, so there's actually a tail on the bottom of the bar. Actually, am I wrong? No, this is it. I'm wrong. No, yeah, it looks like the open is exactly at the low. Yeah, so I'm wrong. On the CME chart, the low is exactly at the open of the day, which is really unusual. Okay, here's an example. On TradeStation, the low is exactly at the open. But if you look at the CME, there's a little tail below. That's what usually happens. So if the day session has a low exactly at the open, it's probably a wrong price. And the correct price, if you look at the CME website, you usually see a tail. Another example, on the TradeStation, the low is exactly the open, but the CME is actually a small tail below. Low at the open, but CME is a tiny tail below. Here's an example where the low and open remained all day. Another example. Another example. And that's, I don't know how long I've been creating, it's probably at least 5 or 6 years. And so we've had 3 examples in 5 or 6 years of the low exactly at the open. Here's an example of the high exactly at the open. Below 2, market double top, up on 2, down on 2, up on 3, down on 4. If I were still long, would I get out? If I were still long, I probably, I might get out. I might wait to see if 5 closes near its low and then get out below 5. And for the bears, they're hoping this is similar to this. Very strong rally and formed a lower high, and then we get a new low. Very strong rally, a lower high, and the bears are hoping we get the new low. We have a low of 50% pullback, which is right there. But that's also right around the neckline of the micro double top, 1 and 2. So you get some bears selling there. Testing yesterday's close, testing yesterday's low. What's likely here? Is it going to be a bear trend? I still think it's a good candidate for the low of the day. Right now, probably a 40% chance it'll remain the low of the day. If 5 closes on its low and 6 goes below 5, then maybe only a 40% chance. The more it goes down, the more likely this will not remain the low. Remember, it only happens about once a year that the open of the day and the low of the day will be true all day long. So most of the time, if the open is at the low, 1 of 2 things happens. You go below that low. You can then go up again, but 1 or 2 things happens. Either you go below that low, or you discover at the end of the day, or you check the CME website and you find out there's actually a tail on the bottom of that first bar. Now we have consecutive bear bars, one being big and closing near its low. So theoretically, it's sell to close, but we're at important support. Yesterday's low, yesterday's close, a 50% pullback. Plus every bar today, including bar 1, has had tails. That means every bar today went two directions. So no sustained buying or selling, and therefore it's trading range price action. And if it's trading range price action, you have fewer traders willing to buy high, even if you get 3 bull bars, bar 3, and you'll have fewer traders willing to sell low, even if you get 3 bear bars, bar 6. If the odds are that 1 will remain the low, can you buy at the market and put a stop below 1? You can, but after consecutive bear bars, 1 big and closing near its low, I typically will not buy. I'll wait. Bulls hoping this is a pullback. In a bull trend, the bears are hoping that it's a resumption of yesterday's bear trend, another lower high. Strong rally, but it was a lower high. Strong rally, the bears are hoping it's another lower high. And bulls are hoping we're going to get the higher low major trend reversal. You can see on the 15-minute chart, it's a bull trap. We have a bull channel called a wedge, different ways to look at it, a bull channel, a bull breakout, and a failed breakout. And this is triggering the sell. We're going below the bear bar. Small Globex range, so we still might go below the Globex low in addition to going above the Globex high. What are the chances now that we're going to go below the low of the day? I don't know, I'd say better than 50-50 right now. Can you buy above 7? Higher low major trend reversal? With 3 consecutive bear bars, the bulls will want a pretty good looking bull bar or micro double bottom. So probably not very good buy above 7. Some bulls bought the 4 low, the 3 low. They bought more lower, 5 points, 10 points lower. And they have sell orders to sell at their original price, and that's why we have the tail 7. Well, it looks like we might get a trading range open. Higher low major trend reversal, but bars are big and lots of reversals. And now we're back below the moving average. So not good for the bulls. And for the bears, they do not have a good sell signal bar 4. Now they have a bull outside up bar and a higher low double bottom. So not good for the bears. If I were short, and I'm not, I'd get out above 7. But it's not strong enough for me to get long. So right now I'm flat. Right now we're in the middle of an open that has a lot of trading range behavior. For the bears, a low 1, but possible micro double bottom and higher low major trend reversal. And you can see might be more traders buying below 8, betting the bottom of a trading range, than bears selling below 8, betting that we're in a small pullback bear trend. The bulls who bought the 8 low probably put their stop below 1, and the bears who sold the 8 low have a stop above 7. Most traders, this is trading range behavior, then it's better to wait for second signals. Selling below 4 is a second signal, a big tail, so not great. Consecutive bear bars 4, 5, 1 being big, closing near its low, so it's sell to close 5. That's not great either. The bulls trying to get a second buy, but they'll need a pretty good buy signal bar 9. Higher low double bottom, higher low major trend reversal. The more 9 closes on or near its high, the more bulls will buy, take a chance, right? So they buy above 9, stop below 9 or below 7, or even below 1, and they're hoping that we make a new high of the day. So the reward will be at least 2 or 3 times the risk. If 9 has a fairly conspicuous tail, you'll have fewer bulls willing to take the buy. Also, 9 is becoming very big, and that will additionally reduce the number of bulls willing to buy above 9, despite the higher low major trend reversal. We failed at the moving average on 1, 2, 3, 4. Right? We kept getting tails on top or bear bar, and we're right below the moving average here. The bulls want to buy, but they don't want to buy too close to a resistance level, the moving average, and they also don't want to risk too much. So 9 will reduce the number of bulls willing to buy because it's at resistance, and also the number of bulls who are willing to buy because they don't want to risk too much. So what do? You can take the buy above 9, or you can wait to see if we break strongly above the moving average. Can you sell the 8 high? They bought money. It's been limit order trading for the past several bars. Buying below 6, selling above 6, buying below 8. Will they sell above 8? I would not. I still think we're probably always in long, even though we had 3 bear bars. When you get a lot of reversals, it's confusing. And confusion is usually an indicator that the market is in a trading range. And when the market's in a trading range, traders do not want to buy too high, bar 3, and they don't want to sell too low, bar 5, 6, 8. They tend to take quick profits. So if you do get 3 bear bars, it's probably going to reverse up because the bears will exit. If you get 3 bull bars, it'll probably reverse down because the bulls will exit. Now, I talked about how I exited my final part during 4 because I was concerned that we might be failing at the moving average, and this could be the top of a trading range. Outside up 9, bulls looking for signs of strength. We got to close exactly at the 9 high instead of above, but it's still a very good bull run. However, as I said, big bar just below the moving average that will reduce the number of stop order bulls buying above 9. Possible low of the day. If you do take the buy, you're looking for a reward at least twice the risk. So it's not a terrible thing to do. So that's 1 times risk, and 2 times risk will be up there. It's interesting how, I don't know if you can see, the pink line is exactly at that March 3rd high. The computers, they're playing chess. They're thinking several steps in advance, and they put the high of 9 exactly where it needed to be so that a measured move up would be there. So theoretically, a bull buying here, stop below here, profit target here, the reward equals the risk, and the probability might be about 50-50. It's probably better than 50-50 if we go above 9. And 2 times risk takes us almost exactly to the 60-minute moving average. You can see it popped above 9. It's also a 15-minute high 1. 15-minute chart breakout. An attempt at a failed breakout. It became a high 1 buy. But very big bars makes it more neutral. Hesitation at the moving average. We failed there. 2, 3, 4. Bears want a low 2. And a break below the low of the day. Bulls are hoping this micro level bottom is the start of a bull trend. Most traders better off waiting for more information, and that means more bars. Bulls micro double bottom 7-9. Bears trying to get a micro double top 7-10. Breakout mode. Markets deciding: is this the start of a bull trend, or will we fall below the low of the day for about a measured move down? The more 10 closes on or near its low, the more bears will sell. Double top bear flag. They're hoping 5 is the start of a bear trend, and that this is a pullback in the bear trend. And the bulls are trying to get a close above the moving average, a close far above the moving average, a close above the 9 high. Consecutive bull bars, one big and closing near its high. So it's a reconfirmation, or it's a confirmation of the by the close bar 2. So it's still by the close, but we're right at resistance. And despite the big bar 1, there was not enough buying to get above the moving average. Bears hoping that this is going to be a low 2 top. It is, but nobody wants to sell below a bull bar 10. Most traders should wait. Breaking above the moving average, so more bulls are buying. Bears want double top 3. Can you buy the close or buy the market for a scalp? I think if you're buying, it's better to buy for a swing. Next stop, 60-minute moving average. 60-minute moving average. It's been pretty important. Resistance, resistance, resistance. Broke above it, not very far. Resistance, resistance. And bulls are hoping that this time we'll break successfully above it. Bears want double top 3, and bulls are hoping that we're going to continue up above the 60-minute moving average. Sorry about that delay. I'm working with the administrators trying to get the Alice Notes program working again. The bulls have a double bottom, 1-7. The bears have a double top, 3-12. I think we're always in long. But tough for the bulls to hold short, to hold long if it goes below 12. And for the bears, it's not a great short after 3 bull bars closing in their highs. So I still think it's always in long, and I still think it's more bullish than bearish, but we're at the top of a trading range open. Will the bulls exit longs below 12? I would either exit longs below 12 or 5 or 10 points below 12. And for the bears, can they short below 12? I think it's a low probability trade, but I think it's an okay trade. You're selling below 12, hoping we fall below the neckline 7 and fall for a measured move down. So you're trying to make maybe 4 times your risk. And what's the probability? Right now, maybe 30%, but 4 times the risk is still a reasonable short. Now, for the bulls who are long above 9, right now their stop is below 9 or below 7. What's the probability that we're going to go up above the double top? I think it's probably 60 or 70%. But we may test down first. Trading range open. Most trading range opens have both a double top and a double bottom breakout mode. And here, I think it's slightly more bullish than bearish. Bar 1 is so dramatic, plus we're oversold. And as I said on the daily chart, we're testing support for 5 days now, and the bears were unable to push it through support. Support is that March 3rd high. We're a little bit below it, but we're not collapsing. So support right now is still holding. And if the bears try to do something 2 or 3 times and fail, they usually buy back shorts. And the bears have tried several times to break far below that support, and they're failing. So at some point soon, if they're unable to get a strong breakout down here, they'll buy back shorts. And the bulls will see that the bears are failing, and the bulls will buy more aggressively. And then this ends up forming a higher low in a bull channel. Higher low, higher high. If the bears do get a collapse, the bulls will give up. So breakout mode, the bulls will give up down here, the bears will give up here, and we could get either a swing up or a swing down. You can see a high one, but traders are hesitant to buy too high in a breakout mode pattern. For the bears, it's a short below 12. For the bulls, they just had a high one buy above 13. Traders are deciding, is this going to be a bull trend or a bear trend, or will the trading range continue? It's okay to be long. It's okay to get short below 12. Most traders probably better off flat, but the second best choice is long. I was just typing to get Al's notes up to date. The administrators fixed Al's note problem. Again, it's still on the buy above 13. The bears are trying to prevent it from going above 12 because the bears will give up if we break above the double top. I think it's slightly more likely that we're going to go up. And I say only slightly because that's accurate. It's still possible that this is the top of a trading range and that we reverse down. It would have been better for the bears had 13 went below 12 to trigger the sell, but it did not. You look at it and say, well, can't the bulls get this to go up? Everybody sees it's a good-looking buy signal bar above the moving average in an early bull trend. Well, until we've broken strongly above the 3 high or the double top 312, the bulls are not strongly in control. And that means there still are a lot of bears taking a chance that this is the high of the day. Bulls, I'd get out below a bear bar closing below its midpoint, like bar 12, maybe bar 15. And for the bulls and for the bears, can they short below 15? It's a 7-bar bull microchannel, bar 9, and we're above the moving average. So that lowers the probability for bears shorting below 15. And so I might get out of, I'm currently flat, but if I were long, as I said, I'd get out below a bear bar closing below its midpoint. What about getting out 4 or 5 points below 15? Well, that's the same as getting out below a bear bar closing below its low 12. Can you buy on a stop above 15? I think we're always in long. I think you can buy at the market, you can buy on a stop, you can buy with a limit order, but I'm going to wait. It's just not doing what the market typically does in a bull trend. So it makes me not want to trade it like a bull trend. A bull trend, I'm happy buying at the top, betting it'll go higher. This is a bull trend, but it also looks like it could be a bull leg in the trading range. Not a good sell, 15 low, so probably more buyers than sellers below 15. But if 16 is a bear bar closing near its low, you'll start to get bulls giving up. Right now, it's a small pullback bull trend, a bull trend since 7, a small pullback below 8, a small pullback below 15, but not strongly bullish. you can see not a lot of buying going on here. It's equally, there's as much selling going on. And how do I know that? Well, if there's buying, we go up. And there's as much selling as buying, and that's why we're going sideways. Well, right now we have a small breakout low pattern, double top 12, 15, and then the 12 low, the neckline of the double top. So some bears might sell below 12, and some bulls might buy above 15. And then the entire day is breakout mode. We have a bigger double top and a bigger double bottom. I'm always respectful of the exact opposite of what I think is likely. Right now, I think it's slightly more likely that we're going to go up. And I say slightly because until there's a strong breakout, the bears still have a decent chance that this is the high of the day, a double top. You can look at an upside down version of the E-mini, the SDS. It's an upside down version of the spider. This is delayed chart, but you can see for the bulls, it's a bull trend and a double bottom. It does not look all that bearish. Remember, this is basically the upside down of the E-mini. It's the SDS, which is an ETF that is a leveraged version of the inverse of the spider. So basically an upside down E-mini. Breaking below the 12 low, so you're getting more and more bulls giving up, disappointed, and you're getting more bears willing to short. Bears want to get strong bear bars. They want to get bear bars closing near their lows and below significant support, like the 12 low, the moving average. And they want big bear bars, and they want consecutive bear bars. They had consecutive bear bars 4, 5, 6, but bottom of a trading range. Now they're trying to get consecutive bear bars in the top half of a trading range. So this might attract more sellers if 17 closes on or near its low. If it closes at the moving average and above the 12 low, then probably more limit order trading, more bulls buying than bears selling. So good for the bears, but traders in general like to see consecutive closes beyond support or resistance. 11 closed far above the moving average, but not consecutive closes. 12. Bears have a close below 12, the neckline of the double top 12, 15, a close below the moving average, but the bears will want to see a second consecutive bear bar, 18. And the bulls will try to get another higher low. Higher low 7, they want higher low 18. We had a bear channel on Thursday, lower high, lower high, lower high, and lower lows. And the bulls are trying to do the opposite. They're trying to get a bull channel. They're trying to get higher highs and higher lows. Bulls are hoping 17 is a bear trap and that we get a higher low 18. If they get a bull bar closing near its high, closing at or above the moving average, you will get bulls buying. Anything less than that, the bulls will wait. The bears want any kind of follow through. They just do not want a bull bar 18. Important bar. The more bullish it is, the more traders will look at this as a bull channel. The more bearish it is, the more likely this will be a trading range, and the market will test down near the bottom of the range. It's still a possible bear trend from Thursday. But I think more likely 2 strong reversals up over sold. I think it's more likely it will be sideways or up. For the bulls, it's a high 1, a pullback, and a bull trend with 3 bear bars. So not a lot of buying. A bull bar closing near its high, 19. But to me, it looks like it's still deciding what to do. For the bears who sold for any reason below 12, below 16, below 17, the close of 18, their stop is above above 15, and therefore You will get bulls buying above 15 because they know bears will give up there. And for the bulls, can they buy above 18, above 19? I still think it's always in long, and I still think it's better for the bulls. But why are the bulls not able to demonstrate better strength? So I still think best choice is flat. I think it's okay to be long, and I think the probability for the bears is less. If the bears get a bear bar 20 closing below the moving average and closing on its low, then I think the odds will start to shift in favor of the bears. You can see nobody willing to buy high and bet that will go higher, and nobody willing to sell low and bet that will go lower. It's still breakout mode. Market's still deciding. Is this a bull channel, 7, 18, or is this a double top? And it's both, but we don't yet know which will win. Better, I think, to wait. But if I had to choose long or short, I would choose long. However, if 20 closes near its low and below the moving average, I would give up on longs, and the odds probably will start to shift in favor of the bears. What happens if 20 is a bull bar closing near its high? Well, then we'll have consecutive bull bars closing on their highs and above the moving average. That should attract buyers. The problem everyone has right now is the uncertainty. It tends to look the most bullish at the top, 11, 13, but traders don't want to buy high. Look most bearish at the bottom, bar 8, and they don't want to sell low because they're concerned we're in a trading range and we could just keep reversing all day. Bears trying to get another sell. They're trying to get a lower high in the start of a bear channel. They're trying to get as good a sell signal bar as they can get. They'd like a bear bar closing on its low below the moving average. Reasonable swing short. Math is not good enough for stop entry scalps right here. I'm still flat. I did not sell below 20. I did not buy above 19. But the bulls are failing. No follow through after 11. No follow through after 13. A lower high here. Bears need to do more to convince traders that this is the start of a bear trend. Some bulls are still long from buying during bar 1 or above bar 1 or the close of 1, or buying above 7 or above 9. As I said, I think it's still slightly more bullish than bearish. If we go below 18 and get another reversal, then it'll be a wedge. 3 pushes down, 12, 18, and who knows, 22, 23. Bulls trying to get more bull bars closing near their highs. Yeah, everybody's eager for a trend. And right now we have both a bull trend and a bear trend. We have higher lows. If we keep going up, you'll look at this and say the bull trend began here. If we keep going down, you'll say the bear trend began here. So at the moment, we're both in a bull trend and a bear trend, which is always the case when the market's in a trading range. It's always also both in a bull trend and a bear trend. And there's always a reasonable sell setup and a reasonable buy setup. It's reasonable to be short, stop above 12. It's reasonable to be long, stop below 7 or below 1. But higher probability, wait until things become more clear. Right now, it's balanced, bulls and bears. A weak entry bar for the bears. Bulls will try to get a higher low. So basically a lower low double bottom, 12, 18, and then a higher low. And if it goes below 18, they'll try to get a wedge, 12, 18, and maybe 24 or so. And the bears are hoping that the bulls will give up and that will break below the low of the day and fall for a measured move down. I'm still flat right now. I'm willing to buy, I'm willing to sell, but it's not doing what I want. At the moment, if I were doing anything, I'd be short below 20. That's the most recent signal. Bulls will try to get a bull bar 24 or a wedge bull flank 12.18. And the bears are hoping that this is a small pullback bear trend that breaks below the low of the day. Right now it's on the short below 20. I would get out above a bull bar, maybe 23 or 24. I'm flat. I did not take the sell. So right now I'm stuck on the sidelines. Bears are trying to get a sell to close bear trend. It's becoming more bearish. And the more bear bars they get, the more bears will start selling and selling more lower. And the bulls want to get a wedge bull flag, but they'll need a pretty good bull bar. The more 23 closes on its low, the more bears will sell the close of 23 and below 23. Other bears will sell on a stop below 7, the neckline of the double top, 3.12, or below the low of the day. Remember, over here, I said it looks good, but until we get a clear breakout, there is no breakout. And it's still the top of a trading range, and therefore we could reverse down. $23 is important. If it closes on its low, I'll probably sell either on the close or below the low of the bar. Just a small position, we're still in the trading range, and then add on lower. If it closes on its high, I might buy if it's a pretty good bull bar. Right now, it's more likely it's going to remain a bear bar. Question is how bearish. Racing down to the 7 low, the 9 low. Because 23 became bigger, I did not take the short. When I'm looking for sell to close and I see a bigger bar, I usually wait. If the market might be buy the close and I see a bigger bar, 11, I usually wait. Because the bigger bar is often a sell back in test of support, the 7 low, the low of the day. 23 looks like 8, and they bought it. So can I buy the close 23? No, I would either sell it or wait. 24, multiple of 12, so it's the close of the 60-minute bar. You can see the bears are trying to reverse the bullish first bar. They're trying to keep the bear trend alive. They're trying to get the second hour to be as good a sell signal bar as possible. I think we're always in short. We have consecutive big bear bars closing, both of them bodies completely below the moving average. But we're at the bottom of a trading range day, and that will reduce the number of bears willing to sell the close. As I said, if 23 did not become a bigger bar, I would have sold the close. And I did not, because it increases the chances. It's a sell vacuum test of support. 7 low, 1 low. So now we have a double bottom 7 and a wedge sell-off 12, 18, 24. So a wedge sell-off to a double bottom. But a bear bar 24. Bears, they might get out 2 or 3 points above 24. And for the bulls, I think it's not good enough to buy. Double bottoms, the second leg often is a wedge. So a common setup. But 4 or 5 bear bars now, I'd want a good bull bar to buy, which we're not getting, so it's still sell to close. Double bottom, 2/3 of the time, the second leg is a wedge. 1/3 of the time, the second leg is a sell climax. So double bottom and wedge double bottom. Bull bar closing near its high, you'll start to get bulls buying. So a wedge sell off to a double bottom. Here, double bottom, a sell climax, and then a triangle. Different ways to look at this as a wedge. We have a lower low double bottom here. Pretty good bull bar. And a bear channel, a small wedge. Look to the left, maybe it's a double bottom, but a good bull bar. What we're not getting today is that good bull bar. So for me, it's not good enough to buy. And I think it's okay to be short, to sell at the market, sell for any reason, but I would get out probably 2 or 3 points on any bar, or 24. I'm currently flat. If you remember earlier in the day, I said 30% chance one would be the low. And by the close of bar 3, I said maybe 40%. But I said there's still a chance we could come down to the low. We were getting tails 1, 2, 3, and then bear bar 4. What are the chances that we go below the low right now? It's probably better than 50-50, probably 60% chance we're going to go below 1. We're breaking below the neckline of the double top. 7 is the neckline, double top 3, 12. But so far, not a strong breakout. Always in short, 6 consecutive bear bars, sell for any reason. But because we're at the bottom of the trading range, I would get out fairly quickly. Maybe 2 or 3 points above a bear bar, maybe a tick above a bull bar closing above its midpoint. We're in a zone where the bulls bought earlier. On bar 1, they bought violently here. Bar 7, they bought. Bar 9, they bought. And we're in that general area as well. Will they buy again, or will they decide that they've tried several times and it's failed, and then think this is too high a price to buy, and they'll look to buy lower? So will they buy, or will they buy lower? Right now it looks like they're going to buy lower. 6 consecutive bear bars, probably going lower. Will the remaining bulls give up 1 tick below 1, or will they buy more, betting that it's either a trading range or we'll get a double bottom and a bull trend? You have some limit order bulls buying at the low of 1 and a tick or 2 above. Others will buy below 1 and below last week's low. Well, if we get a strong breakout below that support, those bulls will exit, and then we might be able to get a measure move down. Just broke below the low of the day. Just broke below last week's low. Is this going to be a measuring gap, or is it a failed breakout below the low of a trading range today? We'll find out over the next few bars. Where's the strong bear breakout? So it's still trading range behavior. Can you buy above 27, lower low double bottom? With 7 consecutive bear bars, most bulls will want a micro double bottom. We have a micro wedge, 24, 25, 27. To get long, the bulls will want pretty good buying. But you can see the problem for the bears. Sell the close, but possibly still in a trading range or a broad bear channel. And traders do not want to sell low, so a lot of the bears. Why are we reversing up on 27? Well, 2 reasons. One is the bears who were short or who sold below 1 wanted the market to collapse below the support, and it's not doing that. So the premise that those bears had is wrong, and they're buying back their shorts because the market's not doing what they thought it might do. And then the bulls think of it as possibly a trading range, and they know traders will buy low. They know bears will buy back shorts, and other bulls will buy. So you have some bulls buying as well. I think getting on our shorts makes sense. If we go 2 or 3 points above a bear bar 26, if 27 closes above its midpoint, reasonable to exit shorts. But with 7 consecutive bear bars, I think fewer bulls will be willing to buy above 27, even if it's a bull bar closing near its high. Some bulls will buy small, and they'll buy more as it goes up. But this is not behaving the way a trend typically behaves. Just like on the way up, I said the tails 1, 2, 3 were a problem. The bad follow through 12, 14, 15, 16. That's not what typically happens in a strong bull trend. And all of these tails at support is not what typically happens in a strong bear trend. Bears, it's a small bull bar with a tail on top. So I would not get out 1 tick above 27. But if I were short, I'd probably get out 2 or 3 points above 27. And for the bulls, a lower low double bottom, but a weak buy signal bar, and 7 consecutive bear bars. So I would not get long. Can you buy above 27 for a scalp? 2 points, 4 points, 5 points? I would not. If I'm looking to buy, and I'm looking to buy, I'm looking to sell. But if I'm looking to buy, I usually don't buy for a scalp and then wait for a swing buy. I usually wait for the swing buy. There might be more sellers than buyers above 27. The bears are hoping that 27, 28 is simply a pullback from the break below last week's low and today's low. You can see might be more traders selling the close of 27 than buying the close. But reasonable to get out 2 or 3 points above 27. Get out of shorts. And for the bulls, it's still too early to buy. I like to see it stop going down, start to go sideways, and then get some kind of a micro double bottom before buying. Or wait for a bull surprise like 9 and then buy. Bulls giving up. Bears trying to accelerate down. More bears selling the market. Can you buy with a limit order? 27 low? I would not. I would either be flat or short. Bears trying to get a gap. The gap is a bear bar closing near its low and closing below the low of the prior bar. So there is a gap. The bears hope it leads to a measure move down. They want it to be a measuring gap. And the bulls hope that it's an exhaustion gap and that we reverse up 29. Bigger bar 28. So that often will attract profit takers. Bears buying back shorts. I don't know if you remember on the open, I talked about how the opening range, how the Globex range was small, and that increases the chances that we break above the top and below the bottom. This is a 15-minute chart. Right now, 5 consecutive bear bars. So looks like we might break below the Globex low. Lower low double bottom 27. I said 27. I would get out of shorts 2 or 3 points above 27. But because this is a lower low double bottom, if 29 closes near its high, I would get out of shorts 1 tick above 29. And you'll get some bulls willing to buy above 29 because of the micro double bottom 27. It would have been better if 28 went above 27. Well, you'll start to get some bulls buying. If we do get a good bull bar 29, the first reversal up will probably be minor. This is right now a 10 bar bear microchannel. It's bar 20. First reversal up typically is minor. Minor means like on Thursday, strong reversal but did not lead to a bull trend. Minor means it leads to a trading range or a bear flag. Here, very strong sell-off, reversal up, probably minor. If the bulls get a second reversal up, they have a better chance of it being major. The more 29 closes on its high, the more bulls will buy above 29, and the more bears will exit above 29. The bigger the tail on the top of 29, the fewer bulls will buy. But for the bears, I would get out a tick above any bull bar closing above its midpoint. If you're a bear, this is not what you want to see. We got a breakout below 1, bar 26 went below but closed above, and then a bull bar 27, and then we have a bigger breakout 28, and a bigger reversal 29. If you're a bear, you don't want to see this kind of buying on a breakout, a bear breakout. And that will persuade a lot of bears to exit, especially if 29 closes near its high. This is what I'm talking about. Bears, I get out of shorts. And bulls, some bulls will buy taking a chance, but it's probably a minor reversal. Bears will try to get a double top with 27, and bulls are hoping it's the low of the day. For the 10 bar bear microchannel, first reversal up, probably minor. Even though we have a 10 bar bear microchannel, which is good for the bears, tails since 24, bull bars 27, 29. We might soon enter a trading range. Possible low of the day, but probably a minor reversal. So okay, buy, but I think it's better to wait to see if we get 2 or 3 bull bars or a micro bubble bottom. Can the bears sell below 30? Double top bear flag 27. I would not. It's a sell climax, 10 bar bear microchannel, and a pretty good bull bar. So bears, I would wait for a low 2, not a low 1. And for the bulls, it's a possible low of the day, but it's probably a minor reversal. So not a scalp buy. And if it's a swing, we'll probably get another buy within the next several bars, some kind of a double bottom. Like over here, reversal of 69, the bears resume down. Here, reversal of 42, the bulls got a second buy. So which is it going to be? A second buy or a resumption of the bear trend from a double top? It's a mistake just to look at 29 and say, wow, that's a really good bull bar. It's a buy. You know, it's probably a minor reversal after this many bars in a tight channel. And therefore, it's not as good a buy as it could be. If we were going sideways for 4 or 5 bars and got 29, you'd get many more bulls willing to take the buy. At the moment, I think bears should be out of shorts, and bulls can be long, but I think the probability is not very high for a swing yet. And if this is the low of the day, then we'll probably rally for at least a couple hours. And it doesn't matter if you wait for a few bars before getting along, if it's going to rally for 20 bars. So no problem waiting for a few bars for more evidence that this is going to be a bull trend. Is it always in long yet? Consecutive bull bars with at least one big and one closing on its high? I don't think so. I think the bulls need to do more. This is still probably a minor reversal. There's nothing to short. I would wait for at least a micro double top, a low 2. So it's on the buy above 29, but it's probably a minor reversal. You know, look at 42 yesterday. Look at 70 yesterday. Both are similar to this. So will the bear trend resume like below 71, or will we get a higher low like below 43? And nobody knows, basically a 50-50 bet. Double top 27, but consecutive bull bars, probably more buyers than sellers below 30. And for the bears, I'd wait for a second sell. And bulls, they either get out below 27, or if 31 closes near its low, they get out below 31. Pretty good reversal for the bulls. We broke below the 7 low, the neckline of the double top. We broke below the low of the day. And we tried to reverse up here. And I wrote that the first reversal up would probably be minor, and the second reversal up had a better chance of being major. And it was. We had, you can call it a little micro wedge. It's probably a small expanding triangle. But there are many ways to look at this. You can look at it as a small wedge, 34, 37. You can look at it as a wedge, 34, 36, 37, and then a failed breakout below the wedge, 39, and then a bigger wedge with 7 and 29, or 18 and 29, or 1 and 29. But in any case, it's a nested wedge bottom. And the bulls got a decent reversal. It's also a midday reversal around bar 40, 41. Outside up, reasonable to buy above 39. Weak entry bar 40, but I thought it was reasonable to hold long. 42, you can call it a little wedge. Different ways to look at it, but 38, 39, 40, 42, a low 1. But I thought after a sell climax, we would get a second leg up, and therefore not a good short below 42. You know, you could get out of longs 2 or 3 points below a bar. 43 did not go 2 or 3 points below. We had a bull breakout 44, close above 42. For the bears, 42 was a wedge bear flag at the moving average. A lower high double top 31, and we broke above it, and we had follow through on 45. And it's possible it was a second leg trap. I thought it was going to be a minor reversal. I thought it's enough breakout above the moving average, above last week's low, above the bear channel, so that we probably would get a second leg up after a wedge that lasted half the day. So 46 was a bear trap. The bulls had a high 147, a double bottom 43, and then a bull bar closing near its high 48, and then the bulls bought aggressively 49, breaking far above the 45 high, double top 31.45, far above yesterday's low, and we had follow through. So by the close, the bulls who bought the 52 high or the 53 high were disappointed 54. They could outbreak even 55. That's why we had that tail on top, but probably a minor reversal. We had 7 consecutive bull bars, many of them closing in their highs. Probably only a minor reversal. We had an IOI 55, so a low 2 top, a failed breakout high of the day, higher high double top with 12, a failure at the 60-minute moving average and the March 3rd high, but probably a minor reversal. Reasonable to get out of longs below 55 or a couple points below 55, but I would not short. High 157, but might get a couple legs down after the buy climax, and we did. 58 was the second leg down. 59, a big bull bar closing near its high. Possible resumption of the bull trend, but on top of a trading range, 51, double top 54, at resistance, the March 3rd high and the 60-minute moving average. So yeah, always in long, and it's also a buy above 61, but we get that bear bar 60, We did not reach the moving average 58, so anybody buying above 61 probably needs a wide stop, at least below 58, the neckline of the double top. For the bears, it's a double top, 54.60, sell below 60, but I would not. We've probably seen the low of the day. And we may go sideways here. We were sideways here for 20 bars earlier today. Over here, we're at the same price. And I suspect we'll come down to the moving average in the next several bars. But I think the downside is probably limited. I suspect we'll hold above the 58 low, which right now is lower than the moving average. So if we pull back to the moving average, possibly get some kind of a double bottom, 58. Will we go a lot higher? Probably not. We've had a lot of reversals today. Here. So while I think we've seen the low of the day, I don't think we're going to go a lot higher today. 60-minute chart, the bulls are trying to get above the moving average. They've been trying for 2 weeks now, and it gets a little bit above, but it doesn't hold above. And now you can argue different ways to look at this as a wedge at a key support, the March 3rd high. The bulls need a strong breakout soon, maybe today, maybe tomorrow. But if they do get a strong breakout, then this might be the low for the next week or two. March to April, it's a very bullish time of the year. So we may try to work higher into the end of April. Right now, it's on the buy above 61, but we may come down and test the 58 low and the moving average. So if you take the buy, you need a wide stop. You're buying at the top of a tight trading range after a very big bear bar and another big bear bar here. So there may be sellers above. This might be similar to 13. You can see not a lot of buyers above 61, despite the high one and the good bull bar 59. I think the market probably has to touch the moving average before the bulls will buy aggressively. So if you buy here, stop at a minimum below 58. And for the bears, it's a double top 54.60, pullback 62, so double top, pullback, sell 62. Possible high of the day, double top 12, but probably a minor reversal. So the best the bears probably will get is a test down to the 58 high, less likely 45 high. I would rather be looking to buy, but I'd rather buy after it touches the moving average and reverses up. That was the minimum that was likely. We were likely to touch the moving average. Did not quite get there, 58. But decent, quick sell-offs, 58, 60. In a resistance zone, high of the day, 60-minute moving average, the March 3rd high. So the odds were we'd have to get down to the average price. We may go lower. The bears have a double top, 54.60, neckline 58. It's possible that we get down to the breakout point, 45 high. Right now, I think it's more likely we're going to go sideways here. And on the open, we had a double top and a double bottom. Here we have a double top, 54.60, and we might get another double bottom, 58 and 63, 64, 65. I suspect that that's what's going to happen. When we had the earlier double top and double bottom, we get a bear breakout. And here we have a double top. I suspect we'll get a double bottom. And I don't know that we're going to break out. We may simply stay in the current range. Bulls are trying to get as good a buy signal bar on the daily chart as possible. And they would like the day to close near the high. And they would like it to close at least a few points above the 60-minute moving average. Both of those things would increase the chances that we go higher tomorrow. And the bears just want the market to continue to drift down. They're trying to get down here. This is the daily chart. We're in a small pullback bear trend, but it's probably a bull flag in this bull trend. The bulls need a good buy signal bar. They tried to reverse up here, and if they get a good buy signal bar today, I think the odds are they'll try to go up for the remainder of the week. If today closes the way it is right now with that conspicuous tail, it's still a buy signal bar, but fewer traders will buy it. High 261, a pullback to the moving average, but 3 consecutive bear bars and a trading range since 52. So limit order trading. Traders buying below things, buying more lower, selling above things, selling more higher. It's always in long above the moving average. In general, it's better to be focusing in on the buys. For the bears, a low one below 65, but a bull bar, and we're above the moving average, so not a very good sell. The bears are trying to get a break below 58, neckline, double top, 54.60, and then a measured move back down to the open of the day. They're trying to prevent the day from being a bull bar, especially the bull bar closing near its high. They'd like the day to close around the open so that the daily chart will have a doji bar instead of a strong bull bar. Probably buyers 65 low, probably buyers 58 low, probably buyers at yesterday's low, Thursday's low. Not a very good sell below 60, below 62, below 65. Everybody's waiting for more information. So not a lot of trading going on. More information means more bars. The bears want a big bear surprise bar. The bulls want a bull surprise bar. The bears want some kind of a additional double top or reversal down from the top of the range with a smaller bear bar, allowing them to sell higher. The bulls want a reversal up from around where we are now with a decent bull bar. They don't want to be buying 61 at the top of the range, and the bears do not want to be selling below 65 at the bottom of the range. Most traders better off flat right here. Bulls hoping for a wedge, 60, 64, 66. So possible buy the close 66. Bears are trying to break below the neckline, 58. I think we're going to go below 58, but not necessarily much below. And I say that because the entire day is a trading range day, and then we're additionally in a trading range since 52. And trading ranges tend to disappoint traders. The bulls do not want the market to go below 58, the neckline of the double top. And what would disappoint them if we went below it? What would disappoint the bears if we went below 58 and reversed off? Is there any reason to be long right here? Not from a stop entry. I would not be long above 59 or 61, but some of the bulls have bought above 59 have a stop below 58. Some of the bulls above 61 stop below 58. That's another reason to expect it to go below 58 to run the stops on those bulls. Probably not a lot of sellers below 58. Probably it'll be mostly bulls selling out of longs and then nobody left to sell. It's not a very good sell for bears. So if we go below 58, it'll be mostly brief selling from bulls exiting longs and no additional selling from the bears because the bears do not want to sell too low. They're happy to try to flush the bulls out by going below 58, but just like the bulls will sell out of longs below 58, the bears will sell buy back shorts. So I suspect there'll be buyers not far below 58. Bears buying back shorts and strong bulls getting long. Weak bulls getting out and strong bulls buying and bears buying. So this is the breakout right here. Will it be a big bear bar closing on its low and far below 58, or will it be unclear? Will the bears sell this aggressively? Bulls are giving up. either one tick below 58 or a point or two below 58. But below that, there may not be many sellers willing to sell this low. The bulls will wedge 60, 64, but two decent bear bars, 67, that will reduce the number of bulls buying 68. Most bulls will want a very strong 68 to undo the bearishness of the two bear bars and the tight channel. Right now, might be always in short, but I think the downside is limited. The bears are trying to get below the breakout point, 45. It's similar to what I talked about on the daily chart over here. When we were up here, I said, daily chart, trading range for 9 months, we should fall below the breakout point, which we did. And the market's deciding, is it support or are we going to break below it? Trading ranges, the market tends to go through breakout points. We broke strongly above. Chances are we were going to dip below. In 5-minute chart, we broke strongly above the breakout point, and we may have to dip below. Can we get to a new low of the day? Probably not. Can we get to a new high of the day? We're running out of time, and I suspect we might not. It depends. Sometimes the market will make a strong move right at the end of the day. On the daily chart, today potentially is a very good buy signal bar, so the bulls might buy strongly into the close and get the day to close at a new high. That would increase the number of buyers tomorrow. It's possible the bears could get the day to close on the low, but I don't think they will. The moves up and down today, the moves up were stronger here, here, and here, especially this one and this one. They're much stronger than the bear moves here and here and here. So overall, I think the bulls have been more aggressive. What do you do right here? If you're short, I would only be scalping, trying to get out 5 or 10 points. Suppose you're swing trading. I'd get out a tick above the bull bar closing above its midpoint. I would get out 2 or 3 points above any bar, for example, the Doji 68. And despite the wedge 60, 64, 3 bear bars, not a good enough stop entry by 68 or 69. Trading range type of behavior, disappointing. Just dipped below 45 high, so we may get some buyers here. The bears who were expecting it to go at least a tick below that high will buy back shorts, and some bulls will buy and scale in, betting that we've reached a target and there'll be a bounce. Always in short, but not strongly bearish, and we're at a support zone. Thursday's close and the breakout point. 4 consecutive bear bars that will reduce the number of bulls buying above 69 or 70. So bulls better wait for some kind of a micro double bottom. Not strong, sell the close. And for the bulls, a lot of bulls will want the market to stop going down, begin to go sideways for 3 or more bars, and then look to buy above a good bull bar, preferably after a couple bull bars or at least dojis, like 36, like 37, 38, 39. It's still sell the close, but I don't think we're going to go down much further. A lot of times the market will test the bottom of a buy climax, the 47 low. So it may go down another 10 points, I don't know. And with 6 consecutive bear bars and a tight channel for 12 bars, most bulls are not going to buy the first reversal up. So not great to sell the close and too early to buy. Trying to get down to the open of the day. The bears do not want a bull bar on the daily chart. And if there's going to be a bull bar, they want a small bull body. So the bears are trying to get the day to close around the open. And the bulls are running out of time. They need the day to close near the high so that today will be a strong buy signal bar on the daily chart, and it does not look like they will be able to get that. Too many bear bars, too tight a channel, too little time for the market to get back up here. These past 6 bars all have fairly conspicuous tails. Earlier on over here, I said that those tails made it unlikely that we'd go a lot higher without a pullback. And tails mean that there's buying all the way down. Not enough yet to create a reversal, but it's enough to make a lot of bears wait for a pullback to sell. They don't want to sell at the low if every bar has some buying. Even a tail on top of a bar represents buying. The market went up and then down. Here it went down and up. Here it went up and down. So tails represent both buyers and sellers. Getting near the open of the week and last week's low and the 47 low, that was the start of this climactic rally. It's late to sell the market and sell closes here. You can do it for a swing, but as I said, I'd be pretty quick to get out. A tick above a bull bar, a couple points above a bear bar. It's still a trading range day for the bears. It's a double top. They want to break below the neckline and fall for a measured move down. Not enough time to do that. Thursday, we had a very strong rally here, and it was just the second leg in a double top. And the bears did get a measured move down, or about a measured move down. And they're trying again here. We have a double top here. We're about a measured move down. We have a bigger double top here. Probably not enough time to fall below the neckline and then down for a measured move. It's still more likely a trading range day, multiple reversals, up and down and up and down. And I suspect that we'll get at least a little bounce before the end of the day. Bigger bar, it can represent acceleration down, but in a trading range day, it's more likely to represent exhaustion, like 28 or bar 3 or bar 11. Bears trying to get a new low of the day, another failure at the 60-minute moving average, which has been resistance now for several days. 60-minute moving average, you can see starting a couple of weeks ago, we broke strongly above it and strongly below it, and we've been unable to hold above it. And today we failed at it as well. Why would we be collapsing here? Well, part of it is bulls who bought for any reason are giving up at the end of the day. Some bulls were buying here thinking it looks like a bear leg in the trading range, and they were hoping for a profit-taking bounce at the end of the day, and they're panicking out. And for the bears, would bears be selling down here? I think this is probably mostly bulls panicking out than smart bears suddenly deciding it's a good time to sell. The smart bears sold up in here, not selling down here. The bears selling here are the weak bears who are afraid they're missing a stock market crash, so they're willing to sell at the bottom. But trading range day, smart bears want to sell high, not low. So most of the selling 73 is from weak bulls giving up and less from strong bears. Bear surprise 73 might get a little bit more down. Well, I still think it's going to remain a trading range day. The bulls wanted the day to close near the high. Now they'll be happy to have it close around the open. They don't want it to close near the low. Bears are hoping that we break below the neckline 39 and fall for measured move down, but they know it's unlikely. We're going to run out of time. They'd like the day to close on the low. Bear surprise 73 probably will get at least a small second leg down. Some bears will sell the close and then sell more, 5 points higher. betting that it'll go back to their first sell price. They can get out break even on their first sell and with a profit on their second sell. Is there any reason to buy, use a wide stop and scale in? Nope. No reason to buy yet, even though we're probably not going to fall much further. Micro double bottom, sell climax 75, bottom of a trading range day, higher low double bottom 39, but way too many bear bars. So even though it's a parabolic wedge sell climax, it's 9 consecutive bear bars. Okay to get out of shorts, but I think it's not a very good buy. Similar to 28-29, probably a minor reversal. Better to wait to see if we get a second reversal up. We don't have enough time, so bulls, it's really difficult. They either buy about 75 or wait for tomorrow. I think the math is not very good. Bears, I'd get out a couple points above a bear bar 74, a tick above a bull bar 75. Bulls, a higher low. They're hoping that this is simply a pullback from this rally, but too many bear bars. Sometimes you'll get a bunch of bear bars and then the market goes straight up. We had that a few years ago on the daily chart. I don't know if I can find it. Yeah, here. I think we had 10 consecutive bear bars at the end of the year, and then the market reversed up violently. But that's unusual. Normally, when you have that many bear bars, the first reversal is minor. You can argue this was minor. We had a pullback, but this is more of a small pullback. Bull trend, a V bottom. That's not much of a pullback. So it's unusual to get a V bottom where it goes straight down and then straight up without more of a bottom. And that's similar to this. Reasonable to get out of shorts, but not great math for bulls hoping for a big reversal. Bears trying to get another IOI, inside, outside, inside, like 55 and like 4. But what's different now compared to those? Well, those were after rallies, possible reversal down. And this is in a strong bear trend. So selling below 76, I think, is less reliable. I'm currently flat, and the bulls are going to run out of time for a buy. Let's say they get a reversal on 77, and we start to go sideways. If we have a tight trading range, bar 75 or later, it's usually better to not take any more trades. So important bar at 75. For me, I like if the trading range has 4 or more bars, then I usually do not take any more trades, because if you do the math, even if you win 60 or 70% of the time, you will lose enough money on the losses so that you will not make money using that strategy. So if you get a tight trading range, 4 or more bars at bar 75 or later, it's probably going to remain more of a limit order market, and therefore trading with stops is not worth it. 75 is a pullback in a bear trend, bear micro channel. Therefore, it's theoretically a low one sell signal bar, but a bull bar in a sell climax and a possible double bottom 39. Most traders are not going to sell below 75. There will be some institutional bulls buying the 75 low and buying lower, betting that will stop going down and start to go sideways. But individual traders, I think, better to wait for tomorrow. What about buying above 77? The math is not very good. Remember, I said if the market has 4 or more sideways bars in a tight trading range at bar 75 or later, it's usually better not to take any stop entry trades. This is bar 77, and we have 4 sideways bars. Probably not worth buying above 77. Could we get back to the moving average? Yep. We can get back to yesterday's close, the moving average. But this is how much you have to risk. So that's your risk, that's your reward. Your reward is right around the magnets, yesterday's close and yesterday's low. And your risk is about the same as your reward. So if you're going to take a trade and you plan to exit at around the same as you plan to risk, then you have to be right 70 or 80% of the time to make the strategy worth taking. And is it 70 or 80% certain buying above 77 will lead to a measure move up before it hits the stop? I don't think it's 70%. It might be better than 50%, but it's not 70%. Could you take it and hold, hoping we go all the way up to the high of the day? That's probably a 10% chance. So I think the math is bad here for buying above 77. You buy above 77, risk is below 77, and you want at least a reward equal to your risk. And if it's just 60% certain, it's basically a break-even strategy. For it to be a profitable strategy, you have to be 70% certain. And I do not think it's 70% certain that this is going up to that pink line before it gets down below this pink line. Risk happens fast. So if you bought above that, not much profit potential. Above that, not much profit potential. Let's say you bought above that, and then the market hits your stop. Good looking bull bar, bottom of a bull channel, but turned out more sellers than buyers above. Good buy signal bar, and went above and then below. So it doesn't have to happen very often to make the strategy bad. That was an example when it turned out to be good for the bulls. But if you sold below 28, below 8, below 46, bad for the bears. If you bought above 59 or 11, bad for the bulls. For me, the math was not good enough, so I let it go. However, the bulls are trying to get the day to close as close to the high as possible on the daily chart. They're trying to get as good a buy signal bar as possible. Right now, we're in the middle of the range, and the bulls would like the day to close on the high. They would like it to close on the high above the March high, March 3rd high, and the 60-minute moving average. That's probably not going to happen. Trading range day today, lots of big moves up and down, and they all reverse. So strong up, strong down, strong down, strong up, strong down, strong up, strong down, strong up. It's, I think, an unusual number of big reversals. It's not unusual to have a lot of reversals, but it's unusual to have a lot of big moves up and down like this. Yesterday, Thursday, was a sell climax day. Pretty strong sell-off. So we knew there was a 75% chance that we would have at least a couple hours of sideways to up trading at some point today, starting by the end of the second hour. And we were sideways for about 21 bars. We sold off, but these two strong rallies early in the day reduced the chances that today would be a big bear day. So if the market sells off, which it did, it probably would lead to a bear leg in a trading range. And instead, we got a reversal bar 39. There are 81 bars in the day. Well, you could argue there are 78 bars in the day. And those three last bars don't count. However, the market tends to try to reverse around the middle of the day. So bar 40, 41, 39, and today it reversed on bar 39. And when you get those midday reversals, they're usually from some kind of a wedge bottom or wedge top. And in this case, there was a wedge, and several ways to look at it. It could be a small wedge 1, 2, 3, or a small wedge 39, a failed breakout, a small wedge 37, a break below the wedge 39, and it failed and reversed up, or a bigger wedge 28, 37, 39, or a bigger wedge 18, 28, or 7, 28, or 1, 28, and then 39. On the open, we had an exceptionally big bull surprise bar. I call it a major bull surprise bar. And if you get a bull surprise bar that's about 3 to 4 or 5 times bigger than the average bars, it's a really important bar, and it tends to dominate the entire day. Most surprise bars affect the next 5 or 10 bars, but if you get an exceptionally big surprise bar, it often will affect the entire day. And that's what we had on bar 1. And by that, what I mean is it makes a bear trend day unlikely. So if you get a sell-off, the sell-off will probably be a leg in the trading range, or you'll probably get a reversal, and that's what we had today. I said on the close of 1 that you could buy the market, you could buy above 1, that we probably would get at least a small second leg sideways to up. And that's what bar 3 was. We went below 2, and then we got a second leg up 3. And then we had a second reversal down 4. But a big tail on the bottom of 4, a major reversal 1, probably a minor reversal, so I would not short below 4. We had consecutive bear bars, 4 or 5, with at least one big and closing near its low. So some bears will view it as sell the close, a bear surprise. So you'd expect at least a couple legs sideways to down. First leg down 6, second leg down 8, and then reversed up. So on the open, we had consecutive bull bars, 1, 2, with at least one big and closing near its high. So it's buy the close. It's sell the close 6, but we're still above the 1 low, so you could argue that we're still, that 6 is just a pullback, and that we're going to go higher, which we did. I mentioned on the open of the day that bar 1 opened exactly at the low of the day and did not trade below the open. And I said that when that happens, most of the time it'll fall below the low of the day. Only about once a year will you see a bar on the daily chart where the low is at the open or the high is at the open. Normally, the high will be above the open and the low will be below the open. So that was one thing to keep in mind at the close of bar 1. I checked the CME chart to confirm that, in fact, the low was exactly at the open, and it was. So that made it pretty unusual. Bar 1, I said 30% chance we've seen the low of the day. 1, 2, 3. Maybe bar 3, maybe 30 or 40% chance we've seen the low of the day. And that made selling below 4 a lower probability bet, especially after 3 bull bars and with a big tail on the bottom of 4. I pointed out that yesterday is whatever's to the left of the dashed line. This is today. So I know this is Thursday, but I call it yesterday. We had a very strong rally here, and it failed. And we're in a bearish channel. Rally here for over an hour, it failed. And I said it's possible that 1, 2, 3 formed a bull trap and the high of the day, and that we will reverse and go down to a new low. But I said 4 was probably a bad sell signal bar. It would not sell below. So bulls buy the market on the close of 1, or wait for a second bull bar by the close of 2. For the bears, they wanted a reversal down from the moving average, double top 76, but I said there'd be buyers at the 2 low. And the close of 3, I said, yeah, we've got 3 bull bars, but we're stalling at the moving average. We have big tails on the top of all 3, so not good by the close. We got an IOI, an inside bar 4 after an outside bar, but a bad close above the moving average, not a good sell below 4. Sell the close 5 or 6, but I think there's not much downside, so I think it's probably more a leg in a trading range. The bears were hoping 3 was the high of the day. They see 8 as a low one sell, but a big bar after a big bull bar 7, and we're still theoretically on the buy at the close of 1 or above 1 or at the close of 2, stop below 1. So I think it's a low probability sell below 8, and you can see there were more buyers than sellers below. Big outside up 9, higher low major trend reversal. Bear trend yesterday, strong breakout, and then a higher low, and it's a small double bottom, higher low. Possible low of the day, but a big bar, so the risk is big, and you're buying just below the moving average. So the probability is less. And I think the size of the sell-off, we have big up, big down, big confusion. We're probably going to form a trading range open. So if you buy above 9, you need a strong breakout. You got an 11, a terrible follow through 12. So it looks like we're going to form a double top as well as a double bottom. Double bottom 1, 7, double top 3, 12. Bull surprise bar 11, breaking far above the moving average, but bad follow through 12. High 1, 13, and I said I would not buy it. I'd wait to see if we broke strongly above the high of the day and then buy higher. You're buying just below a possible double top, 3 and 12. So there might be more sellers than buyers above 13. The bears got a small double top, 15, 12, inside of a bigger double top, 12 and 3. But 3 consecutive bull bars, 15. Most bears are not going to sell that. We got a bear surprise, 17, 3 bear bars, 18, 2 closes below the moving average. Might get a small second leg sideways or down. And for the bears, they got a decent sell signal bar 20, closing on its low below the moving average. They have a double top pullback, double top 12 and 15, and a pullback with a good bear bar. I think it's a reasonable swing short, but we may get a reversal up from below 18 for a possible wedge, 12, 18, and 22 or 23. Instead, we broke strongly below 18, consecutive big bear bars closing at the lows, 22, 23. So we're probably back to sell the close, and we'll probably get at least a small second leg down. But with the bull surprise 1, the major bull surprise, and then the second strong reversal up 9, 10, I still think this is not going to be a big bear trend day, even though right now, 23, 24, it's sell the close. Tails 24, 25, 26, 27, probably a minor reversal. And the bulls try to get a reversal up 29, micro wedge 24, 26, 28. Bull bar closing near its high, a micro double bottom 27, 29, but a 9 bar or 10 bar bear micro channel. First reversal up should be minor. 29, 30, a good looking pair of bull bars, but it's similar to yesterday, 69 and 70. Probably a minor reversal there, probably a minor reversal here. So it's not good by the close. The bears have a low 2 short, 32, closing on its low. A reasonable short, but I don't think we're going to go down all that much further before the bulls try to get a reversal. We had 2 major bull surprises here and here, and usually you're not going to get a strong bear trend day when you have that. And therefore, this is probably not a strong bear trend, which means it's probably a bear leg in a developing trading range, or we will get a bull trend reversal. Consecutive big bear bars, 4 of them, 31, 32, 33, 34. A low one, 35, but a bull bar, possible wedge with 28, 34. So I'm not going to short that. We did get the wedge, 35, and several ways to look at it. One is 28, 34, 37, or 18, 29, 37, or 7, 29, 37, or 1, 29, 37. But a doji and a 6 bar bear microchannel. So it's better to wait for a second reversal up. We got that on 39 outside up, bull bar closing there its high. A good candidate for the low of the day. A nested wedge and a midday reversal. A bad entry bar, 40, a doji bar, so it could be another minor reversal. Maybe we'll get a trending range day, upper range breakout, lower range. But I think it's a buy above 39. 41, a bull bar closing above 40, good, but just below the moving average. 42, a lower high double top, 31 at the moving average. But we should get a second leg up after a wedge bottom. And here we have a nested wedge bottom. And typically, when you get a reversal from a wedge bottom, you're looking for about half as many bars as there were in the wedge. And the biggest wedge had 38 bars in it, 37 bars. So we should rally for 20 bars or so. That reduces the probability that a short below 42 will get very far. Now, you can call it a wedge rally, 38, 40, 42, but then we broke above it, 44. 44 broke above the wedge bear flag, 42. It broke above the moving average. It broke back above last week's low, and it broke above this bear channel. So might be a measured move up. 45, a bull follow through bar, probably always in long. You'll try to get a failed breakout and a reversal, but with the bull bar, I'm not taking the short. And 46, it's possible that it's a double top 31, but I still think we should get a second leg sideways to up, so I'm not willing to sell below 46. And 47, a higher low major trend reversal, head and shoulders bottom, 29, 39, and 46. And whenever you have a wedge bottom and then you get a reversal, you're expecting a couple legs sideways to up. The pullback from the first leg usually forms a right shoulder of a head and shoulders bottom, and the second leg down of the wedge forms the left shoulder. So that's what we have. We have a wedge bottom, different ways to count it, but this is the second leg, third leg. So the second leg is usually the left shoulder of a head and shoulders bottom, and then the bottom of the wedge is the head, and then the pullback from the first leg up forms the left shoulder. You can buy about 47. I think it's better to buy about 48. And we got a surprisingly strong breakout at 49, so it's back to buy the close. 49, 50, 51. And then 52 tails, and we're at resistance. High of the day, the March 3rd high, and 60-minute moving average. 53, we have 7 consecutive bull bars, so probably buyers below 53, but I don't think we're going to go up all that much before we pull back more. We're starting to get dojis and smaller bodies, 52, 53. Outside down, 54, and then I 55, but a bull bar 55, only one bear bar in the past 8 or 9 bars, and it had a tail below, so it's probably a minor reversal. I think we're going to get down to the moving average, but we may go sideways and form a trading range first. Reasonable to get out of longs below a bear bar, 54. You could get out below 56. You could get out a couple points below 55. But I think the first reversal down will be minor. 57, a high one, but a doji after a bear bar after 54. Right below the moving average, a failed breakout of the earlier high of the day. I'm not buying above 57. If you do, you need a wide stop. Bear surprise 58, big outside down, but big tail. So it looks like a trading range. 59, a big bull bar closing on its high, but the top of a trading range and right below the 60-minute moving average and the March 3rd high. So I don't want to be buying high, and I certainly don't want to be buying high above a big bar because the big bar means bigger risk. The bears have a double top 54, 60, a pullback 62, a possible sell. I think we're going to dip below the moving average. We may get down below the 58 low, possible down below the 45 low, but I doubt we're going to get a bear trend. But we did get a bear trend. The bulls, we pull back to the moving average 64, higher low double bottom 58, the 3 bear bars. I'm not going to buy that. Might be sellers above. And for the bears, they're hoping 60 will remain the high of the day. 65 is a low one. We have a bear trend, small pullback bear trend, starting at 60. A bull bar at the moving average. I don't want to sell that. Then we had 66, 67. A pair of bear bars closing near their lows, both closing below the moving average. And one of them, the body is completely below the moving average. So to me, that's sell the close, or you can wait for one more bar, 68. Tails, 68, 69, 70. Might not fall all that much further, but we did. We collapsed down to a higher low. Sell the close 70, sell the close 72, 73, a bigger bar late in a bear trend near the low of the day. And still sell the close, but that will attract profit takers. A lot of the bears will buy back shorts. That could be the final bulls giving up. And for the bulls, a parabolic wedge sell climax, a spike down 66, 67, then a parabolic wedge sell off. But on bear bar 74, I'd wait for a second buy. 76 is a second buy, but another bear bar. About 77 outside up. I think you could buy above 78 or 77, but I don't think we'll get up to the high of the day. However, I was wrong. We did get up to the high of the day. Another big bull surprise, 78. And this is another major bull surprise, just like that. And tomorrow is probably going to trade higher. On the daily chart, we now have a decent buy signal bar. It's a third reversal up above this, above that, above that. I think it's a good buy for tomorrow. So I think the market's probably going to go higher, at least for a few days. Possibly we might get another leg up above this March high. So overall, it looks good for the bulls. Stop entry traders, you can buy above 1, not great. You can buy above 9 or a swing. You can buy above 13. But I'd like to see it break above the double top. And then for the bears, it's a sell below 20, or you could wait for it to be clearly always in short, 23, and then sell below 23. Minor reversal 29, I did not take the buy. A low too short 32, probably not a lot more down, but it's sell below 32, below 33, below 34. I'd buy above 39, above 41, and above 44 on the close of 45, but I would get out a couple points below 45. I'd buy again above 47 or 48, and then 49, 50, 51. And then for the bears, double top pullback 62 or 63. Or if you want higher probability, you wait for 67 and then sell the close 67, 70, 72, 73, big bar late near the low. I would not sell that. And if you want to take a chance, 77. Turned out it was very good for the bulls. If I were not talking, I probably would have bought a small position on the close of 78, taking a chance that we were going to try to get up to the high of the day. Limit order traders, the easiest one was buying the 2 low, major bull surprise, consecutive bull bars. And this was all limit order trading in here, trading range. I thought that we were always in long early on, so I'm more interested in buys, buying below things, but really the best one was buying below 2. And then down here, after all these bear bars, you could probably sell 29, but I thought after the early strong rallies, R1 and 9, we're not going to go a lot lower, so I'm not really eager to to sell below 29. You could probably buy below 30 for a scalp, but you would have been lucky to make a couple points. And then at the low, below 35, possible wedge, 28, 34. Bulls will start to buy. More bulls will buy below 38. 42 is a wedge bear flag, lower high double top. 31 at the moving average, but a good candidate for the low of the day, so you can buy below 42. 43, a little bit disappointing, big tail on top, but you could buy below 43. But where's your stop? You could get out below a bear bar closing near its low. 46, you could get out a couple points below a bull bar. 45, or you could use a wide stop below 39, which is probably the best choice. And then up here, probably buyers below 53 or scalp. And then 57, I thought it was a bad high one. I thought there would be sellers above and we would enter a trading range. probably sellers above 64, and that would be it. But really good day for the bulls. Remember, I said early on, I said on the open, I thought that the bulls would try to get a rally for several days, and this strong reversal at the end of the day increases the chances that we're going to rally for a few days. Could be longer, but at a minimum for a few days. Okay, I don't see questions. Let me make sure that, let me turn on this question box. I'll wait a few seconds and see if any questions pop up. Okay, question, is it okay to sell the close of 21, stop above 20? Is your probability a lot better than selling directly below 21, below 20? Yeah, if you have consecutive closes below the moving average and you have a double top pullback, I think you could sell below 20, or you could wait for 22 or 23. Now, what's the best way to trade Bitcoin? It has no opening and no closing hours, and the 5-minute time frame seems too volatile. But would it be great? It would be great if you made a video about it. You know, I trade Bitcoin, but I trade it as if it's a stock, and I don't day trade it, although I have day traded it. Mostly, I'm looking for swings on the daily chart, and as you know, it's been sideways for off the daily chart. There are many. When you say trading Bitcoin, Bitcoin could be many things. You know, for example, this is BITO, which is an ETF, and I've been recently trading the ETFs, and you can see we've been sideways for January, February, March, and April. We're low in the range, so I'd rather look to buy. But and it's a high too, like double bottom, a higher low, so it's a reasonable buy. So buy with a stop above the high of the bar tomorrow, or buy at the market and hold, hoping we get back up here. So you might get a 20% swing up. But right now, it's highly correlated with the stock market, and you know, I tend to prefer trading stocks than trading Bitcoin. I have a fundamental problem with Bitcoin. I think the concept, the idea of a blockchain is good, but I'd rather have a government run it. And so I'm resistant to the existence of Bitcoin. I wish the United States and Europe would get together and form a blockchain, basically a currency with the United States and Europe. Neither one in control, entirely controlled by buyers and sellers. But I don't see that happening anytime soon. But because Bitcoin really doesn't have enough of a reason to exist, I'm resistant to buy it. And you know, people talk about Bitcoin as digital gold. That's nonsense. Here's gold, and this is what happened during the war. People fled to safety, and they bought gold. And here's Bitcoin, and nobody fled to safety, right? So it's not a store of value. It's not digital gold. So for me, I don't like Bitcoin. You know, I wish it would go away, but it's here at least for the next several years, and I don't think the government is going to totally screw all the Bitcoin owners. So I do think it's a tradable asset. Right now, it's highly correlated with the stock market, and it's not performing as well as the stock market. So I'd rather be trading stocks than trading Bitcoin. A question: when you're buying pullbacks in a trend, how are you deciding if you're going to buy the close or the low of a pullback bar versus a tick above the trend bar resumption? I'm very flexible in what I do. My preference is to look to enter with stops, buying up one tick above a bull bar, closing near its high. And that's the simplest way to do it. Sometimes I'll enter late if I'm talking I'll end up entering late, and that's no problem. If I think the market is strongly up, I'll just buy the market or place a limit order, maybe a few ticks down. But in general, I think keeping things simple is the best choice. So if you think the market is going higher, look to buy above a bull bar closing near its high. If the tail on the bottom, top of 47 makes you uncomfortable, wait for a bull bar closing near its high 48, or buy on a stop above a prior high 45. Good question if we're near the top of a trading range and we get a buy low, buy the close, BLB, COH, bull bar closing near its high. If we're near the top of a trading range and we get a bull bar closing near its high, at what point can we take a long trade? For example, 48. Possible trading range here. You buy above 48. I think you could buy for a swing because of that nested wedge bottom, and we're probably going to rally for a couple hours. So I would not hesitate to, even though it's a possible top of a trading range, I would not hesitate to buy above 48, or you can wait for 49.50 and then buy. Question: is it okay to use the 1 minute chart to enter and exit early? That question comes up every now and then. I think traders should trade one time frame. And if they can trade the 1 minute chart profitably, consistently profitably, and they're having fun doing it, they should do it. Most traders cannot trade the 1 minute chart consistently profitably. And therefore, I think they're better off not looking at it, because if they're long and they look at it, they'll end up exiting too soon. If they're flat looking to buy or sell, they'll end up buying a minor reversal or selling a minor reversal, and they'll end up losing money. So I think it's better to trade a higher time frame chart, maybe a 2 or 3 minute chart. Most traders are better off trading a 5 minute chart or a 15 minute chart. Question: would you buy calls here if you think we're going up? Yep. I think it's reasonable to buy calls or buy call spreads, because I think we're probably going to try to go higher for several days, possibly for a couple of weeks. Now, do you have any special hardware or broadband connection or any brand or kit connection that you would recommend? I'm not all that tech savvy, and I don't have any special connection. I have a Wi-Fi setup, but I also have one of the guys in the room recommended that I buy one of those things that you plug into your outlet, and then you can use the wiring in your house as a hardwired connection. And then you buy that little box. You plug your router into it and plug it into the wall, and then you can buy a second box and put it anywhere in the house and connect an Ethernet cable from that box to any computer anywhere in the house. I forgot what the term of that is, but I got a bunch of them all over the house, and televisions and computers all over the house. I have them all connected that way. So I'm using Ethernet cables on everything. Okay, question R45. We closed above 30. Yes. Okay. Should we think that there might be more upside bars? Yeah, I don't know if I mentioned that. The 45 was, I don't remember if it closed above 30, but it's very close to closing above 30. That increases the chances that we'll go higher. Actually, I think it looks like it closed above 30, but not above 31. But I thought because of the wedge, nested wedge bottom and the midday reversal, we would rally for at least half as many bars as we had in the sell-off. The sell-off was about 40. I'm looking for about 20 up. So to me, that is the most important reason. Okay, question. At what bar and how many times did the market flip the always in direction today? I think it was always in long in the close of 1. I said 6 could be always in short, but I think it's probably more of a bare leg in a training range, so I think a minor reversal. Probably back to always in long 10. Always in short again. I would say probably 22 or 23. Always in long again. I thought probably 39, but clearly 45 or 49. And then up here, always in short, 67. And then here, always in long, 78. Okay, I took more questions today than normal. Normally, the administrators set it up and pick 3 questions that they think would be the most helpful. But the administrators did not do that today. Also, my throat is not that bad today. A lot of times I'll get a sore throat by the end of the day. All right, so it looks good for the bulls, and we should go higher. This could be the end of the sell-off. Here's a 4-hour chart. We have a very strong rally here and a wedge. Different ways to look at it. You can call it 1, 2, 3, and then a reversal up from below the wedge, or you can call it a wedge 1, 2, 3 at support. Anyway, we're repeatedly trying to buy at the breakout point and a 50% retracement. So it looks like we're probably going to go here or here or here over the next couple of weeks. So that's 200 points on the E-mini. All right, hope everybody has a good night.